The Federal Reserve, the Bank of England and the European Central Bank have all adopted programmes of quantitative easing since the financial crisis took hold in 2008. Yet amidst all that's been written on the subject, there's very little on how quantitative easing is supposed to work, or whether it has in fact worked at all. When I was a student, I learnt that if there was a plentiful supply of liquidity to the banking system, then there'd be easy credit for businesses and households, which in turn would encourage them to spend more. It was never clear that this mechanism worked well in recessions. Nervous business and households might be reluctant to spend and invest however much liquidity was available to them. The connection between lax monetary policy and inflation when the economy was overheated was much clearer than the connection between loose monetary policy and growth when the economy was depressed. But that was then. Now there is far more liquidity in the financial system, most of it supporting the short-term trading of financial institutions. Or at least the appearance of liquidity. When confidence evaporated in the autumn of 2008, so did liquidity. The primary intention and effect of central bank interventions since 2008 has been to restore such liquidity. As a means of stimulating business investment and household spending through easier credit, this has been like pouring water into a leaking pipe in the hope that some might dribble through. Politicians and bankers argue about whether low levels of business lending and consumer credit are the result of lack of supply or lack of demand. But whatever the cause, the absence of consequential economic stimulus is the same. The main effect of quantitative easing is to boost asset prices. But is this the best way to promote growth? Let's look at the distributional impact of the policy. The one certain consequence of boosting asset prices is that those who have assets benefit relative to those who don't. Many people own houses, but although we need more houses, we don't need another housing boom. The public also holds financial assets indirectly, largely through pension funds. But here there's been a paradoxical effect. Because of the way pension funds are valued, quantitative easing has generally increased pension fund liabilities more than their assets. The truth is that there's almost no direct evidence of the macroeconomic effects of monetary policies post-2008. The one certainty we do have, however, is that countries which committed to fiscal rectitude early on have not come through the crisis as well as those more ready to adopt fiscal stimulus. And herein lies another paradox. Most opportunities for long-term investment are in infrastructure, within the public sector, or associated with or financed by the public sector. Yet austerity-minded governments, rather than take advantage of real-term negative interest rates to raise long-term finance and make such investments, are instead cutting capital expenditure. And all this while their central banks buy back long-term debt from private holders. Why has so much attention been given to these monetary policies with no clear explanation of how they should work and little evidence of their effectiveness? The very phrase quantitative easing seems designed to discourage non-technical discussion. But the real answer, I fear, is all too familiar. These policies may not benefit the non-financial economy much, but for the financial services sector and those who work in it, they're a life raft.